Option chain looks like a flight timetable but behaves like a war zone. Let's learn to read it before it starts flying over our heads. Hi, I am Pranav VK and your options trading guide here at Stockshaala. Welcome back to Stockshaala by Kotak Securities. In this video, I'm going to cover everything about option chain analysis, what it is, how it works, and how can you use it effectively. When I started off trading, options trading was very intriguing because it was difficult to understand what is option chain analysis, what is option chain, what are these calls, puts, and all of these different things. But once I started understanding them, options trading became very logical. So I urge all of you to go through this video with utmost attention so that you can trade effectively in options. So let's get started. Whenever you look up an optionable index or a stock, you will see a grid called option chain. It will have call options on the left hand side and put options on the right hand side. And at the center, you'll be able to see all the different strike prices. Let's get to the whiteboard so that you can visualize this better. As you see here, you can see that the strikes are going to be at the center, the calls will be at the left, and the puts will be on the right. Imagine this to be like a hotel room booking sheet where every strike is a room. And we have guests on either side who believe if it is a call side, then the guests are expecting that the price is going to go higher, and if it's on the put side, then the guests are expecting the price to go lower. Let's understand the key columns that are visible in an option chain chart. The first thing you can find is called the strike price. It is the level at which the option can be exercised. The second thing you're going to find is the last traded price of that specific contract. You're going to find this on the either sides for call options as well as put options for each individual strikes. Next, you're also going to see the different Greeks. Earlier, we have discussed the 4 different Greeks, that is delta, gamma, theta, as well as Vega. You will also be able to see the various Greeks for each strike that is available for the underlying asset. We will also find implied volatility, which is basically the market's expectations of movement, or even you can call it as the level of uncertainty in the market. And finally, you're also going to look at OI, which is called as open interest, which means it is a total active contracts for that specific strike. Think of it like Zomato for traders. LTP is what customers are paying. OI is the number of people who have already ordered. And finally, IV tells you how spicy the market thinks the dish is. Now let's head to the real trading platform and understand the various columns. Here, I have opened the option chain of Nifty and the expiry is 23rd September, 30th September. We have multiple options. You can choose whichever you want. For the ease of understanding, let me choose 7th of October. Once I choose that, you'll be able to see the various columns, starting with the strike price, the implied volatility, which is IV, the last traded price, the OI, which is open interest, and the 4 different Greeks, that is gamma, Vega, theta, as well as delta. Let's go to a normal option chain. This is an advanced one. So here you can see that whether you choose Nifty or Bank Nifty, all of them automatically have different strikes which are predetermined and predefined. So let's also go to Sensex. When you go to Sensex, again you can see here the difference is of about 100 rupees for each strike. It was similar in Bank Nifty, but whereas for Nifty, it is only 50 rupees. Each strike has a difference of 50 rupees. Now, spot price is 25,169, which means the nearest strike to 169 is 25,150, and that is going to be at the money for this specific underlying asset. And the IV for that is 54. You can also see that there are OI bars. These red lines that you see here are the open interest bars for the put option, whereas the green bars that you see here is the open interest for the call option. You also have an option to not see it by clicking on this specific button, and if I click it back, then you can see that the OI is coming back once again. So they are basically the open contracts that is available in the market already. So now let's understand and choose a specific strike and look at all the different columns. Let's say, for example, we look at 25,150, then the LTP, which is the last traded price for this premium for this specific strike, is 264, and the OI is 0.39 lakhs, and the delta and other values are not available at this point. We can also look at on the other side for put option, where the premium is 122 rupees and the open interest is 0.79 lakhs, and again the Greeks are not available at this point. Let's go back by one more week and see if the values are available. Since it is off market hours, right now the theta values, gamma values, and basically the Greek values are not visible at this point. But you will always be able to open it up and check for each of the different strikes. Now don't worry if you don't know what is open interest, because we'll be covering that in detail in the upcoming videos. But just to give you a high level overview of what is OI, let's consider three different conditions of how pros use this. The first one is high OI, the second one is change in OI, and the third one is calls versus puts. Considering the first one, if there is high OI at a specific strike, it means that more participants are interested at that level. The second one, change in OI. If you see a sudden spike in a specific OI, it means that positions are being built in that specific level. And finally, comparing the OI of calls versus puts. If calls OI is higher than puts OI, it means that calls are stronger than the puts, which means the market is expected to go down. Whereas if put OI is higher than call OI, then the market is expected to go higher. So basically, higher OI on either call side or put side basically acts like support as well as resistance. We will be diving deeper into this in the upcoming videos. Let's summarize what we have learned so far. We understood that option chain is nothing but a grid where it has strikes in the center along with calls as well as puts on either sides. It also gives us some crucial information like the various strikes that are available for the underlying asset, the premiums for each of these strikes, the Greeks, that is delta, gamma, theta and Vega values, along with implied volatility, that is IV. And most importantly, it also gives you open interest. Option chain is basically like a battlefield map for traders. So make sure you're focusing on the OI, observing the IV spikes, and finally looking at support and resistance through OI analysis, and make a decision based on context and not on emotions. In the next video, we're going to decode what is this mysterious open interest and why it changes everything. Don't forget to like, share and subscribe. You're watching Stockshaala by Kotak Securities and I am Pranav VK signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.